Good morning, everyone,
Morning.
and welcome to our DAT Weekly Market Update. This is our update from March 15th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and Ned Damon, who is our Principal Data Scientist. Good morning, gentlemen.
Good morning.
I'm starting to feel like spring has sprung a little bit here in Ohio. The snow has melted.
Nice.
It's the small things.
Yeah, no, I got some planting done in my garden this weekend, so definitely moving into that spring mode.
Nice. I got to swing by the bank and try to get a mortgage to fill up the tank in my truck on the way home. But other than that, all things are chipper.
Right.
So I want to thank everyone for joining us here this week and every week. We're here every Tuesday at 10 a.m. Eastern to talk about what we're seeing in the freight markets. And more importantly, go over your questions. So if you have any questions, please drop them in the comment or chat below. We will be sure to get to them at the end of the show. We have a lot to cover this week, so I'm going to get right into the key points of the week. Van and reefer spot rates are down by about the same amount that fuel went up. That's a very confusing sentence, we know, so we're going to spend the bulk of today's show explaining what we mean by that and the two parts that go into a rate, even if it's not explicitly defined, which is fuel and line haul. Flatbed rates are continuing to rise a bit heading into that spring season. It is St. Patrick's Day on Thursday. We're recovering from Pi Day yesterday, so lots going on this week. And then West Coast port congestion, say that 5 times fast, is easing ahead of the next surge in imports, all that patio furniture and umbrellas and all that stuff. Next week, Port of LAX is forecasting 34% week-over-week jump, which is 17% higher year-over-year. With that, I will turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. Welcome, everybody. Having a look at the load-to-truck ratio and dry van volumes dropped last week. Again, they're down about 30% in the last month, so there's definitely some cooling off in the spot market there. Load posts were down 13% last week. More carriers posting their equipment for loads for the fourth week in a row. The net effect was that the load-to-truck ratio dropped to 4.71. Been a while since it's been under 5. In the refrigerated sector, load post volumes have dropped by the same amount in the last month. Capacity continues to loosen ahead of produce season. That really kicks off next month. The starting line is kind of the Vidalia onion season that starts in April. Load post volumes were down last week. Equipment posts up. Load-to-truck ratio down to 8.88, down 5%. And in flatbed, of course, Ken just mentioned spring is just a week away. I think it starts this Sunday officially. Temps are up, so are flatbed volumes. Loads moved in our network are up 3% last week and up 7% in the last month. Last week's load-to-truck ratio dropped back under 100, back to 88.49, a 6% week-over-week drop. Having a look at our market condition index, we'll start off on the West Coast. After a year of tight capacity on the West Coast, because we talked a lot about escalating spot rates, truckload volumes are tied closely to import volumes, especially in Los Angeles and Long Beach ports. Both terminals are catching their breath at the moment. There is a lull in imports due to the factory shutdown around the Lunar New Year at the start of February. Those volumes are starting to get closer and closer to the US mainland. What we've seen in the last month, spot rates in Los Angeles have been dropping consistently. They're down 30 cents a mile to an average of $2.64 this week. Load post volumes are down 24% over the same time frame. On the high volume lane between Los Angeles and Chicago, rates plunged to their lowest level in 12 months, averaging $2.08 last week. That's down $1.20 a mile since December's peak when import volumes were surging ahead of last year's retail season. The backlog of container vessels is down under 50 as of last Friday, down from the peak of 109. But of course, there is a massive amount of vessels on their way now that the markets are back to work after the Lunar New Year break. As Ken mentioned, volumes are expected to rise next week, although the impact of COVID and the outbreaks in some of the big port markets in China could have an impact on some of that market volatility. Remains to be seen how that plays out. In the refrigerated market, capacity is tightening. As you can see on the map, there's a lot more color in the map on the right side of the country as opposed to the West Coast where it's more blue. Spot rates have been increasing in Florida in the last 3 weeks, up 14 cents a mile. To an average of 207 out of that market. Some of the lanes, Miami to Baltimore, reefer rates jumped 34 cents last week to 278 as the produce season starts to kick into gear. Almost the same amount of increase for loads from Miami to Hunts Point, New York, up to 283 last week. Capacity is tightening in the Rio Grande Valley in southern Texas. A lot of Mexico produce comes across that particular border market through the far crossing. In McAllen, that's the broader market that surrounds the Rio Grande Valley. Rates are up 10 cents a mile last week to an average outbound of $2.99. Nearby Laredo, rates averaged $2.94. Loads from far Texas to Hunts Point, New York, high volume lane for produce, averaged $3.13 last week. That's about 40 cents a mile higher than this time last year. According to DAT's ratecast, spot rates are projected to end March about 16 cents a mile higher at $3.29 before peaking at $3.49 in June as we lead into the Independence Day break. Having a look at the flatbed market, capacity was fairly tight last week in Southern California, San Diego, Los Angeles in particular. Even flatbed capacity was tight in San Francisco. Rates are up across the entire region. In San Diego, rates increased 14 cents a mile, averaging $3.21. North in Los Angeles, overall rates are up just a penny a mile to $2.84. San Francisco recorded the most significant weekly increase. Rates jumped 20 cents a mile to an average of $3.20. Loads from San Francisco to Phoenix were paying just under $3, up 3 cents a mile last week. At $2.98, which is the average last week, they're about 70 cents a mile higher than this time last year. On the just under 400 miles from Los Angeles to Phoenix, loads were paying $3.77 last week, while capacity on the other lane that runs fairly high volumes to Salt Lake City out of Los Angeles, it's about 700 miles. Rates are averaging $3.21 last week. That was down 29 cents a mile. And in our biggest steel market in the country, Gary, Indiana, a lot of steel, finished steel is produced there. Rates jumped 20 cents a mile, averaging $4.05. Having a look now at our year-over-year look at spot rates, wrapping up with dry van. We'll start with dry van first. Capacity continues to loosen. Volumes are shifting away from the spot market as contract rates now are on the rise. Contract rates are on average 10 cents a mile higher than spot rates. That's the first time that chart has changed since December. Spot rates have been higher since then, but now they've inverted. Anecdotally, trucks are beginning to cycle through networks faster. I'm seeing less and less carriers spending more time on loading docks. So there is a bit of fluidity in the market there. So spot rates have declined. They've been dropping for about 8 weeks in a row now, down 9 cents to an average of $2.56 last week. That's about 28 cents a mile higher than this time last year. Similar story in the refrigerated market. Rates have dropped 19 cents a mile in the last month, down 9 cents a mile last week. They ended last week at $2.88, still 28 cents a mile higher than the previous period last year. And lastly, in flatbed, rates have been rising for the last 3 weeks. Last week, they were only up a penny a mile. The average spot rate for flatbed carriers nationally was $2.72, excluding fuel. That's up 6 cents a mile in the last month and about 28 cents a mile higher than this time last year. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report that will be published on Wednesday evening. Over to you, Ned, for the short-term forecast.
Hello, everybody. We're starting off by looking at the dry van forecast. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast lines. I want everybody to take some deep breaths here. I think that this might be overstating the degree of the downslide, but there is definitely a little bit gloomier of a projection in a bunch of the different equipment types. So keep that in your pocket. In red, you can see our short-term forecast is basically down and to the right. Looks like about 30 cents a mile, 20 cents a mile over the next month. In green, our ratecast forecast tracks pretty closely with the short-term forecast for the next 2 weeks before breaking a little bit, having a little bit of stability as we head into the later part of March, and then holding back to that prior trend in the early part of April. In gold and silver are our two blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways, and they both are tracking very, very closely to the short-term forecast for this lane, or for this forecast, set of forecasts. There we go. Moving on next to reefer. Once again, in blue, you can see the spot rates observed by DAT. And then off to the right, you can see that there's a considerable amount of model divergence. Ratecast is expecting the slide to stop and level out a little bit over the next couple of weeks before rising about 5 cents and returning to current levels in the later part of April, or the middle part of April, I should say. And then the short-term forecast, in contrast, is dropping 40 cents, 45 cents over the next month. I think that's a little bit overstated, but we will see. We live in time. And in gold and silver, the blended forecast which are mixtures of those two forecasts in different amounts and in different ways, are leaning a little bit more closely to the short-term forecast, at least initially, before they break and the slope of the slide, as it were, starts to slow down just a hair. Finally, moving into flatbed, a little bit of good news for folks who benefit from high rates. In blue, you can see the market rates observed by DAT. You can see that things have been pretty stable in the flatbed market for a while, but now that we started to break upwards, the models have decided that that's probably going to be sustained. There's a considerable amount of model agreement looking like we're going to be heading up about 7 cents over the next 3-ish weeks in both the short-term and the ratecast model. And then there's a break as we head into the early part of April, with ratecast expecting rates to take a little bit of a dip back down, and the short-term model expecting that the flow just continues up over that period. Finally, the blended forecasts in gold and silver, which are mixtures of the two forecasts in different amounts and in different ways, are trending. They're following the consensus until the break point, and then they're kind of splitting the difference and expecting rates to maintain their level at that juncture. And with that, we're into the IQ question of the week, which is, have rising fuel prices impacted spot rates, and do we expect this to continue? I would say that I would have expected rising fuel prices to affect spot rates in the opposite direction, but that's just me.
So, Dean, you want to give us the update based on EIA fuel last night?
Yeah, EIA came out about 4 p.m. The national average ULSD rate per gallon was up to 5.25. That's up another 40 cents, 40, on top of the 74.5 cents per mile increase the week prior. So looks like the fuel surcharges moved up, went up 12 cents a mile last week. It's up about 6 cents a mile this week. Fuel at these levels is just extraordinary. One of the numbers that we've been talking about for a long time, or I certainly have on the show, is fuel as a percentage of revenue. Remember, 25% of if fuel's around 25% of revenue, that's a pretty stable, long-term, profitable goal. In 2019, it was 32%. At today's rates of 5.25 and 2.56 per mile for spot rates, it's 35%. So it's 3 points higher than where we were in 19 when we had record numbers of bankruptcies. This is causing a lot of pain at the pump for those carriers in particular that can't get full cost recovery or work on all-in rates and are paying retail and carrying debtors for 30 days. These are pretty extraordinary times. We're living through history right now, and I think the challenge is we don't know where this ends. We're all sort of trying to make the best sense of it in real time as we can. So, yeah, we're in dangerous territory when it comes to fuel as a operating cost for smaller fleets that can't, get full cost recovery or hedge the price of fuel.
So let's walk through. That was excellent, Dean. Let's walk through why. Actually, let's take a step even further back. Let's take a longer walk. So most spot loads between a broker and a carrier are negotiated on an all-in basis, right? And when we talk about all-in, let's assume there's no accessorials, just to keep this super clean. So on average, let's just say, to keep the math super easy, you're moving a shipment and the all-in cost is $1,000. And again, these percentages aren't going to be accurate, but I have a rather simple intellect here. So let's just say that even if you're not charging separate, right? Even if on your pay statement, on your rate con, it just says $1,000. Let's just say that allocation-wise, 800 of that went to base or line haul, and 200 went to fuel. Okay, so if you were on a fuel surcharge program, that would have been the rough breakdown between base and fuel. Well, fuel has went up considerably. Fuel has went up 18 cents a mile at 6.5 miles per gallon over the last couple of weeks. So let's just say that you're still negotiating all in, and you're still only getting $1,000 for that load. Your fuel cost did go up, right? That is a real expense. So even though you're not divvying it out on your income, you may only be getting $700 for base, and you're allocating $300 for fuel. In our data, and I guess if you were to look at your data and you had it broken out, you would see you're making less on base and more on fuel. But that fuel is a real expense. It's a pass-through expense, whereas base is the revenue you use to pay for your insurance, your tires, and most importantly, yourself. So you can see as this pie, right? If you think about fuel and base as a pie chart, As that fuel wedge becomes bigger, your wedge becomes smaller. And that's exactly what's happening. So it's counterintuitive, right? You would expect that as fuel prices would go up, I can one-for-one negotiate higher prices. I can pass that cost in full onto my shipper and onto my broker. Not so much the case, especially if you're dealing with all-in rates.
Right.
And that is exactly what we were seeing. I don't have the chart to show here. If you want to see more detail, you can reach out to us at askiq@dat.com. We'd be happy to have a more lengthy discussion. But the long and short of it is, base rates are taking a beating. Total rates are down a little bit. So total rates are holding steady, and that's what you expect in a ceiling type environment, right? Where rates are really, really high. You don't have that pricing pressure. You don't have that leverage to raise your price to your shipper or your broker, but you have to set aside more money for fuel. So that brings base prices down. So spoiler alert, Ned, what do you think happens whenever fuel prices come back? Do those base rates magically go back up?
Oh, no.
They don't. So let's just say in our example, we're going to rehash an example from last week. Let's just say you had a $1,000 load. You were getting 80-20 fuel split. It went to 70-30. Let's say fuel comes back down. And we are seeing a lot of negative pressure in the commodity markets for diesel. Whether or not that actually translates to wholesale and retail remains to be seen. Or retail, that remains to be seen. So let's just say that fuel normalizes back down at what was the 20 level. I don't gamble all that much, but I would venture a guess that the all-in rate becomes 900 and doesn't go back to 1,000. Why 900? Well, then it's 700 plus 200. That's what typically, these are, when we talked about, I think in our Nostradamus episode with Chris Kaplis, we talked about things that could disrupt this market, and I think skyrocketing fuel prices or an energy crisis was one of them. And I think you're seeing why at this moment.
Right.
Yeah. I mean, it's a lever you can use to drive costs down, and that's in like a very broad sense, because, yeah.
Now, if you're on a fuel surcharge program, right? Now, again, most brokers are negotiating spot rates all in. They're most likely behind the scenes. Their finance people are allocating what percentage is fuel and what percentage of that is base, I would assume. At least most decent sized brokerages are most likely doing that calculation. Their spot sell side, so their spot shipper freight, so shipper picks up, they're cold calling or shipper calls them and wants to move one shipment. They don't have a contractual relationship. That's most likely quoted all in. On the contractual side, so between a broker and a shipper, they're most likely on a fuel scale. Most likely the shipper's fuel scale, I would guess. Any large shipper is going to be able to impose their fuel scale. Smaller shippers, the broker might be able to use, if they have one, use their fuel scale. That will move with the market a little bit. It doesn't recapture everything, right? It doesn't recapture some of the cost you might be incurring. But you will see inflated revenues in that instance as a broker. Or as a carrier for that point. If you're listening to us as a large contract carrier and you have a contractual relationship with your shipper, you are able to recoup some of these fuel costs by having a fuel surcharge program. That's what Dean meant by, what did you call it, Dean? Fuel recapture?
Yeah, full
cost recapture.
Recovery, yeah.
Yeah. So if you have a fuel surcharge in place, you're benefiting a little bit, but it's still not, wouldn't you say, Dean, it's not mitigating all of this increased expense.
Correct.
It's only taking away a little chunk of it.
Yeah.
So that's where we are.
Yeah, these are extra. I mean, I just looked at, if you're running a single truck here, fuel is now 46% of operating costs. They're just extraordinary numbers on top of all of the other cost increases carriers have had to endure in the last year. This is sort of margins get compressed. I did some analysis on a single truck operator earlier this morning. So if that truck's running 110,000 miles a year, financed, base current rates, this time last year, the average gross profit per mile was 60 cents a mile, 60. Today, with rising costs, it's 28 cents a mile. So year over year, operating profit per mile is down 31 cents a mile. The net of it is that revenue based on spot rates in the last year, top line revenue has gone up, about 30,000, but fuel's gone up 35,000 for 110,000 miles a year, 100,000 loaded. So margins are getting compressed really, really rapidly for the smaller guys.
So, Nat, I have a question for you because you've been getting away relatively unscathed this episode. Probably top 5 question at AskIQ@DAT.com. I mean, we probably have box trucks, sprinter vans, hot shots, flatbeds. Those are kind of the Mount Rushmore. But usually just narrowing out the top 5 is, Ned, why don't we forecast fuel?
Because the forecasting fuel is really, really difficult, and I would much prefer to let the people who professionally forecast fuel, to whatever degree they are accurate to it, continue to do that particular part of their job, and I'll just do my job.
So speaking of those that do forecast fuel, we have an analytics Slack channel here at DAT, and this is not an old brief from the government, by the way. This was January 13th, 2022. Headline: EIA, which is the government energy something. It's the government fuel energy thing. EIA expects gasoline and diesel prices to fall in 22 and 23 as demand growth slows. Sub-bullet: in our latest short-term energy outlook, we expect regular gasoline retail prices to average $3.06 a gallon in 2022, and from $3 a gallon in 21, then down to $2.80 a gallon. We expect on-highway diesel prices to increase to an average of $3.33 a gallon in 22 before decreasing to $3.27 a gallon in 23. Where's it at right now, Dean?
525.
So they're only off, to be fair, $2 a gallon.
Right.
Yeah.
But the sort of the macroeconomic point, if that's the right term, Ken, is that there's, based on some of the reports coming out of the Sarah week last week in Houston, there's absolutely no appetite to increase drilling production here in the US. I mean, there is a small expectation of 5% growth, but we're currently running around 12 million barrels a day this year. It's down from 13 million barrels a day before the pandemic hit. So some of the comments were like, we're not going to chase growth like we did last year, and investors are looking for more cash flow returns after some of the heavy investments they made during the fracking boom. So this is not an easy fix. I don't know how we increase production rapidly to bring down prices, but that's sort of the backdrop here, is that we're not producing as much from these older wells as we used to when the fracking boom was going on in the sort of mid part of the last decade.
Yeah.
Yeah.
There was the big expansion of capacity. What was it, back in 2018? And a lot of the folks, they just took a bath on that when the prices dropped. And, there's this idea of stranded assets, where if you're going to pump a lot of capital investment into an industry that doesn't have like a long-term trajectory, that doesn't make a lot of sense, as opposed to just taking your profits now and people can deal with it. I don't know.
Yeah.
That's the mean way of looking at it, I guess.
What I don't understand, and I just play an economist on TV, is I'm just trying to get the exact number. So West Texas Intermediate's trading at $94 a barrel.
Yeah.
And gas is, what is it nationally?
Like $5. Yeah, $5. Yeah.
Gasoline's $5 nationally. I don't think it's that high nationally.
Okay.
Is it? Dean, what?
I don't know what the gasoline number is.
Looking it up.
West Texas was bumping up at $120 a barrel this time last week, though.
So gas is $4.35.
Yes.
How come in 2008, when West Texas Intermediate hit $181 a barrel, we weren't paying that much for gasoline?
Good question.
Yeah, no, I mean, I know that there's a lag. The new math is a joke that is now so old that trying to explain it to people is difficult. But
it just, something doesn't feel like it's adding up, and I don't know what it is.
I know there's a time lag on refining, where like if prices have been high and then they drop, like there's kind of a delay on the response. But I mean, honestly, it is kind of odd.
Yeah, I mean, gas only ever topped for like 3 or 4 weeks there in 2008. It barely topped $4 a gallon.
Right.
So, again, I don't know the geopolitical sphere that's happening. I just know that something's not adding up in terms of retail wholesale spreads or whatever's going on. But either way, I mean, we can lament the way that it is all we want. But at the end of the day, it is the way that it is. And it seems like it's going to be stuck here for a little bit at least. So, I mean, what are some, Dean, if armed with new information as a carrier, you could potentially negotiate more stringently, I guess, knowing what fuel prices are.
Yeah, I'd first of all know what my exact operating costs were. So I'd have to go to my P&L. I'd have to certainly talk to my accountant and run some monthly P&Ls to see what my numbers look like, and then do some projections on that and hold firm on that rate. I think that would be the first thing. The other thing would be try and cut some costs, things like idling costs and speed, some of the big ones that can reduce the gross cost each week.
Yeah, wasn't the government telling everyone to drive slower?
Yeah, and that becomes more palatable as rates drop. One of the trade-offs we spoke about last week is if you can run a little bit quicker, you get a lot more productivity in a week. So that's generally the rate per mile offsets the higher diesel costs, but that'll change pretty quickly.
Right. We have a question.
Yes. Mihalio asks, Mihalo, thank you. Why did outbound lanes from Chicago to Indianapolis drop so hard in the last 2 weeks? Midwest in general dropped so hard for reefer equipment.
We're seeing reefer. So reefers are more exposed to fuel, right? You got to put fuel in the reefer market. You got to put fuel in the reefer too, right? I mean, if the reefer runs on fuel.
Yeah.
But yeah, Dean and I were just talking this morning about how bad reefer rates have tanked.
Yeah. It's dropped from $1,400 a load to $1,137 this week. That's a big drop. So they're down. $1,137 is $10 a load less than February last year. So it's been a big drop off out of Chicago to Indianapolis, only 180 miles. So obviously a lot of round trip revenue pricing in that.
Yeah. I mean, part of it's going to be that effective fuel, but I think part of it's just a softening market before we head into produce for reefers.
Yeah.
Weather's warmed up. You're not having much of that protect from free stuff. So
Indianapolis is
that corned beef, though.
Yeah, right. For this week. And cabbage from Jacksonville. South of Jacksonville is the epicenter of cabbage.
I'm all ready. I got my corned beef and my cabbage. Actually, I don't have my cabbage. I got to pick it up.
Right.
I got the main ingredient, though.
We have a second question from him or them. What are the current highest paid short haul under 500 miles lanes for a refrigerated market? That's a good question. We can do some lookups on that and get back to you. If you want to email askiq@dat.com, we can try.
Yeah, please.
Yes.
That's a hard one to do on the fly.
Yeah. There's a lot.
I'm going to move us to try to squirt in under the 30-minute thing here. I'm going to move us to plugs. Dean?
Yes. Tonight, Blog Talk Radio, I'm on live with Chuck Snow and Rico Mohammed talking about the freight markets for an hour on rates and lanes. Of course, we'll be on as usual. Stephen Pettit will be on. I'll be actually on Landline Now tomorrow night, 7 p.m. Eastern on channel 146 on Sirius XM. And of course, we've got the big Mats event next week that everybody's getting ready for. My truck just came out of the shop, got my wheels shined up. I'm ready to roll.
Great. We'll have some product managers down at Mats talking about some of our new lane rating tools. That'll be exciting. But other than that, I'll be on. Where am I tomorrow, Dean? What's the official name of the show? Sales Chatter Live. Sales
Chatter Live, 9 a.m. On YouTube and LinkedIn. You can hit us up on DATIQ on our email and ask us for the link. We can get that over to you.
Yeah, great show.
Deegan and DJ, great show. Yep.
Freight leads everything, right? I got to get those T-shirts printed.
Yep.
All right, with that, I'm going to sign us off for this week. We'll be back here next Tuesday at 10 a.m. Eastern, and we hope everyone has a great, safe, and economical week. Be safe out there. Bye.
Thank you.
Bye.